Ordway from Falcassin, Director of Entrepreneurial Services. And as always, Falcassin loves to educate you, and we have a new topic that recently came out that we have some guidance on. And this is regarding Schedule Cs and losses around Schedule Cs. Now, often this is lumped in with hobby losses, and you might be thinking, well, I don't have a hobby. Well, the IRS may determine that you do have a hobby, depending on how many years that you have taken losses. So there, is always this rule where you can take your income and minus your expenses, and that is what you reflect on your return. So that hasn't changed. The only thing is there's a safe harbor now for if you have losses that exceed 3 out of 5 years. That's when you may be on alert with the IRS, and the IRS is now taking more of a focus of this. And this is something that's very easy for them to catch because they have your return and they have your history of your returns, and so they can very easily see out of 5 years whether you've had profit or not. So today I just want to give you some ideas of what could possibly keep you out of the hot seat with the IRS. So we've been told now that they're going to, just as I mentioned, look at companies that have excessive losses with Schedule Cs. And they want to see that you have 9 factors taken into account. Now, I'm not going to go into all 9 because they're pretty detailed, but I am going to give you the highlights that no factor has any more determination than another, but some could be weighted a little bit more than others. So for example, you should open up a separate bank account for your Schedule C, and we've brought this up for several years, and we really advise you not to commingle. Try not to commingle your business and your personal funds. So go ahead and set up that separate bank account for your business. Maintain good records. So try to have an accounting throughout the year, and it's your responsibility, believe it or not, to keep receipts. And that brings up another point. A credit card statement is not a receipt, because think about it. You could go to Sam's Club, charge $1,000. How does the IRS know that that's not for grapes and that it's actually for office supplies legitimately for your business? So make sure you keep those receipts, and don't take a yellow highlighter to them, because often that highlighter will make the ink disappear, and the burden of proof is on you. Make sure you advertise for your business. The IRS wants to see that you have a profit motive. So if you're actually out there advertising, so if you're a photographer, maybe take an ad out in the newspaper every once in a while, or do something with social media to show that you're advertising and making an attempt. They've also advised having a business plan and revise it as needed. They also want to see that you have the knowledge, training, and expertise in conducting out this activity, or that you're seeking the advice of industry experts, so that you're actually making a bona fide effort to make this a profitable business. They also want to see you devoting a lot of time. They didn't say just a little bit of time, but they did make sure that they mentioned a lot of time towards the effort of this endeavor. So bottom line, here's what I'm telling you. You have to be careful if you have a Schedule C business where you're showing losses more than 3 years, that the IRS can come in and possibly say it's a hobby. It doesn't mean they will, if you also are meeting these other 9 factors. And we're going to make sure, as always, we get these 9 factors out there. Follow us on falcassin.com. We also have a podcast called Accounting and Accountability, and we're on social media platforms too, so you can always find us some way. We make sure we get a blog article out about this, and we'll keep you informed in this area. And as always, we'll bring you new information as we get it.